Hello and welcome to another episode of the Thunderstock Show. I'm your host, Ross Stockdale, Fractional Chief Marketing Officer and owner of Thunderstock Marketing, here to bring you another valuable brainstorm to enhance your life, liberty, and pursuit of property. Today's guest, Martin Cunningham. He is a fractional CFO with Quiver and Arrow Consulting. Can't wait to dive into this conversation. Martin, love the background. Is that your office or is it virtual?
It is virtual. I'm loving that you can hardly tell the difference, huh?
One of the few virtual backgrounds that looks like you could be there.
Hmm.
So, Martin, we're in a group called Provisors. It's a networking group. Um, how has how has Provisors and networking affected your business in terms of development and your opportunities?
Got me in front of a lot of folks from different disciplines and different industries and different backgrounds, and I've met a lot of great people and developed some really strong relationships there. So yeah, it's been very fruitful there.
Yeah, I love being a part of organizations that I can have a conversation the day before and say, I would really like to communicate with fractional CFOs quarter one. And look at us now. So
Mhm.
funny how that works out. Day later, we're in a group call together. And the other thing interesting about Provisors is there's really affinity groups and subgroups for everybody out there that's a professional, kind of like us, that's a trusted advisor. Learned a ton about podcasting, made some adjustments. This microphone that blocks out my dog snoring in the background is from a Provisor's recommendation. So that alone has been a value add.
For sure.
So before you join Provisors, what are some of the things that you've done, to market your business?
My business is a people business, so whether it's provisors or other networking groups or just relationships that I've had across my career and in my history, I've forged those relationships, developed them, and have led to other opportunities and other introductions to other good people. So it does have an exponential and multiplier effect, and I'm very grateful for that.
What is your background prior to becoming a fractional CFO? My assumption is you didn't go to college or you weren't in high school one day and said, someday I'm going to be a fractional CFO. If I had to guess, that probably it hasn't been a popularized term when neither of us were in school. So what's your background like?
Yeah, certainly not. Half of it was true, though. I always did aspire to be a chief financial officer,
Oh,
and worked my way up early in my career and became that chief financial officer on a for companies on a full-time basis. I did make a switch at one point to start my own business and got accustomed to the sales cycle and things like that, and realized that I am not a salesperson. So I did come back to um, the finance world, or the finance organization world, and um, COVID happened, and this, that, and the other, and next thing I knew, I was staring at myself, looking at opportunities, and that's when the fractional model started in its beginning, and I really took to it and embraced it because like in my business, I had a portfolio of clients, and I thought, why not do the same thing on the finance side and be able to support a number of businesses, a number of business owners, and understand their stories and their backgrounds and try and add value there. So I've been doing that for coming up on 4 years now in this fractional CFO model, and haven't looked back since.
man. What are some of the key similarities between being an in-house CFO with being a fractional?
I mean, the similarities are the day-to-day functions. Being a CFO, being that face and that leader of the organization. Interestingly enough, it's the only difference is that I'm not an employee of that organization, but I take that representation very seriously. And when I represent a company and have a client, I really want to serve their best interests and be that fiduciary on a corporate finance level. And whether it's looking at treasury or audit or tax or the reporting or some of the transactions, collections, payables. Um, I dive in there as if I were one of the employees or one of the shareholders and try and drive value and performance in cash flow and profitability.
You work for some pretty large brands when you're in-house. What are some differences that small to mid-sized businesses face in a finance world versus some of these more established larger brands?
Yeah, I mean, certainly it's a lot more focused on cash flow. It's a lot more focused on raising capital. It's certainly a little bit more personal to the owner. The owner sometimes is mom and pop, founder, originator. A lot of times it could be, private equity backed, but certainly run by the founder. So there's a lot of pressure there to perform and deliver for them as well. So just as big companies have the pressure to add value for the share price or stockholder value. I'd say this is it kind of hits home a little bit more with a smaller company.
Yeah, it's much different when I find not only are the smaller companies, hitting closer to home, but you can make a pretty substantial impact on whether it's like a local community or, just a family versus as I don't get as much excitement out of driving, public stock uh value as much as I do around privately held founder vision. So that's
Yeah,
just different strokes for different folks, I guess.
for sure.
So what are some of the challenges that you see working with clients? You've been doing this for a number of years. Are there some recurring themes and trends that you find that a lot of these small businesses face when it comes to finance?
When it comes to finance, I mean, to me, it's a little bit more cultural or process driven.
Mm,
Sometimes to hit an inflection point and hit the stratosphere, so to speak, you need to make some meaningful changes in the organization. And a lot of owners, especially the mom and pops, are very hesitant to change what has been a proven track record for them up until that point and say, hey, we kind of need to pivot here so that we can achieve X, Y, and Z, which kind of moves away from some of the core things that have made them successful to that point.
so part of it's change management and
Mhm.
process oriented. How does AI come into play?
I've used it a little bit, not a whole lot, and I think that for me, the way that I use it is as a tool to support what I do, rather than to replace what I do. So it certainly streamlines and automates a lot of things. It allows me to tap into a lot more resources, a lot deeper resources, than I would accustom just because of the ability to do a lot more in a lot less time. So just
Mm,
the efficiency and the capacity that AI can drive has helped me get to the point faster, I guess is really I would have gotten there at some point, but AI has certainly gotten me there in light speed.
yeah, I liken it to when the .com and the internet hit small business. It's like with a marketing perspective, um, if someone went to school for marketing in the 90s, they would have been involved with television or radio or magazine as some of the primary channels or methodologies to communicate to the public. But then the internet comes along and it's like a whole new thing that probably wasn't taken as seriously as it should have been at some point, but then who would have known, right? It's the same thing with change management. It's like, oh, this has been working for a couple of years. Why would we, risk the internet?
You got it.
And I found through the course of the last few decades that internet marketing, like marketing principles stay the same. I'm sure financial principles stay
Uh-huh.
the same. You know, you want to bring in more than you put out, right? Obviously, and you want to make sure that you plan for the future and you have your historicals like clean and tidied up, like basics. But the method and the madness of how you do it, I found with using AI has saved a ton of time and money. And what used to be someone's full-time job, now they can accomplish in a couple hours a week for some tools. So
Mhm.
I really want to, I'm asking these questions because I want to dive into spending versus investing and how fractional leaders like ourselves can integrate with the leadership team to make some serious changes for small businesses. So, what are some of the ways that you've helped business owners to see finance as an investment versus a cost? Because I find that a lot of small business owners, at least with marketing, one of the educational parts is looking at marketing as an investment. But how do you do that on the other side of the table with looking at finance as an investment?
Yeah, I mean, the primary focus would be to align financial goals with marketing goals. As a CFO, I oversee the company's, overall financial health, including the budget, the cost management, and the revenue forecasting of it. And when we look at marketing investments, we want to make sure that those investments are aligned with the company's overall financial goals. Working with a CMO like yourself, we can communicate together on an expected return on investment or ROI from marketing campaigns, while I can ensure that those resources are allocated efficiently within that budget. So that again, the every dollar that's spent stretches as far as it can and gets the most bang for its buck.
Yeah, I find working with smaller marketing budgets to be a unique challenge because if the ROI is not there, there's no hiding. It's clear as day. Whereas when you have like a $10 million a year marketing budget, maybe 1 or 2 million of it doesn't bring back the return you want, but the other eight can kind of overshadow and hide it. Versus if you have like a $200,000 marketing budget, it's like every dollar really matters. So one of the things that I tell people all the time is if you're looking at me to figure out what the marketing budget should be, um, I'm sure I can give you some insight, but that really should be someone in the finance and accounting department. Um,
100%. It's got to be calibrated with the company's goals so that the marketing budget and investment can align with how it drives top line growth and ultimately has to be done profitably. So we look at margin analysis, and in some cases, depending on the company, you look at um, the performance by brand or by product to make sure that the marketing and advertising budgets by product yield the result that it should.
quick story about that topic. When I was a full-time CMO, we had a full-time CFO on the team, and it was the best dynamic duo relationship for the simple reason that I could go to that person and say, "Hey, I know the founder and president wants to sell X, right? They have this emotional appeal. They really want to push this product line. But like, what's the most profitable product line? And which product line do we have margin on, or maybe excess inventory or excess capacity that we could create a killer offer, a great deal, right?"
Mhm.
And by asking those questions, we completely switched the direction of what we were offering to the public. And we made some pretty astounding cost savings, profit increase. And it's that second and third degree of thinking versus, just, oh, trust me, my gut is follow this plan versus having that communication. So do you find that to be a recurring exercise that you work on with clients and their biz dev and marketing teams, creating
100%.
offers?
Yeah, you hit it on the head. I mean, looking at the most profitable products and with excess inventory or just not just inventory levels, but throughput. So making, sure that our highest producing or highest capacity products that are being manufactured in the case of a good, obviously service, you would look at the cost of service as well to determine where the opportunities are and how best to get it out to market and I'm sure you look at things like velocity and other types of metrics that can be used to determine where to focus your efforts from a marketing perspective.
Yeah. The other metrics conversation is so key to have, right? Because when I first get engaged with a client, it's not like, hey, which service I like to do services for some of the key reasons you mentioned too. It's not like, hey, which service brings in the most revenue? Sure, that's one component, but it's not the silver bullet. It's one of the many golden BBs. I like to look at, what is the total lifetime value of a customer that that is your favorite customer, right? Let's start with there. I'm happy to ask that question at first. Like, who's your favorite customer? Usually there's metrics to support why it's the favorite customer, but they usually feel it, right, in their gut.
Mhm.
And then when we start with that question, then you can start to uncover like the boiling the ocean strategy. Like, okay, well, what characteristics and traits does that customer have? And you say, oh, well, they have a high lifetime value. They've been a customer for a long time. There's cross sell, upsell, downsell opportunity, et cetera, et cetera. Um, but when I work with a fractional CFO, they can they can answer and explain these questions in such a way that's just irrefutable, right? With the data and the analysis behind it. Um, what are some of the questions that you ask when you're starting an engagement with a new client?
Well, I mean, with respect to marketing and advertising, I always like to know what in aggregate the budget looks like relative to sales.
Hmm.
I also like to know where the marketing and advertising is being spent with respect to product or with respect to region or targeted audience, to understand exactly how the company's strategy is being carried out from a marketing perspective. If you're looking at focusing on the Southwest region for some reason, maybe, does it align with where the budget dollars are being spent? Or are we overspending in the Northeast where, everything is generally more expensive? So, there's that type of thing. I also look at, if we're marketing things, it's the cost to make the good, the cost to ship the good, the cost to deliver the good to the customer. And that gives me a feel for how profitable the products are, individually. So I can give some advice or some suggestions as to where there are opportunities either to grow top line or to focus our efforts from marketing and advertising to focus where the profitability is best.
You're leading me down a path that I really want to share from a marketer's perspective. It's the idea of a lead magnet. So if you're familiar with that term, I'm not sure, but for those of you that are listening, lead magnet is typically the thing that you offer a prospect to make them interested in the main thing, right? That's an easy way to describe it. And the way that I go about strategizing what that lead magnet should be and packaging an offer around it is, what is something of value that you can give away for free in exchange to build brand loyalty, to, for more tactically, put them in the pipeline, right, to make them a qualified lead. Um, in the 2010s, that was download my PDF free ebook, right? I think that those days are kind of saturated, but for some product or service businesses, it's like, what can you do for someone for free that you would normally charge for, but it doesn't cost you that much. There's good margin. You don't lose. That increases the conversion rate from prospect to closed sale, and you make your money on the back end. So it's a front end versus back end offer type thing. Um, how do you approach those kinds of conversations?
Hmm. Um, Good question. Um,
I'm
I
really
don't know.
putting you on the spot because it's
You
I
are
didn't give you like a specific industry or
no, yeah.
example.
Certainly, there are industry specific considerations to look at, whether it's heavy investment in capital and other types of things that lead to different types of investment. It's gonna, and of course, you talk about the customer type. Is it B2B, B2C? Um, there are a few different things that I look at and dive into, and you look at data driven results here, and one of the things that we really try and do is make good, sound decisions based on that data. And, by integrating marketing and financial data, we best make our informed and strategic decisions. Uh, as a CMO and a CFO, we work together to determine which customer segments are most profitable. And that way we can focus a little bit more industry wise or on end user or customer.
Yeah. One of the one of the examples of this lead magnet or this financial analysis on what we can offer to get people in the door, um, that still baffles me to this day. Like I can't believe this worked, but we had the example in mind is I was working with a packaged goods, so it was like a pet product, and there was 27,000 SKUs, like just tons of different products, right? Like just if the ERP was a nightmare to manage, right? And we found that there was between 3 to 8,000 of the SKUs that did 80% of the business carried it. So like, Pareto principle 101, 80/20 rule.
Got it. Mm-hmm.
And we were running a sale one year, and it was to try and do SKU reduction, right? Like the thesis was if you cut the amount of SKUs in half from 27 to like 12 or 13, now we're getting much closer to only carrying the stuff that really carries the business. And we're like, well, how the heck do we get rid of this? And the idea, and we thought, oh, well, if we do a price down, markdown, well, we keep margin. And there was like a marginal uptick in sales here and there, but it would have taken years and years and years to reduce the SKUs. Like we would just spin them in, sure, we're not losing money, we're making money. But one of the things that we did that I thought was genius in hindsight was bundled the dogs, the ones we don't want, right?
Mm-hmm.
And instead of trying to sell, you know, 10,000 SKUs all, one to one to the consumer, we go to key B2B retailers and say, look, here's this massive spreadsheet database of all these products. MSRP is X. Asking price is Y. Get a steep discount. You got to buy it all. So in that was some of our 20% of our SKUs that were awesome.
Mm-hmm.
And when you look at the numbers, you're like, oh man, we could be getting a steep discount on these products. But we also included products that we didn't want to sell ever. And in that, they're like the emotional appeal was, well, we could get a lot of really valuable stuff and just have to deal with the dogs ourselves. And that one play increased our top line revenue by 20%, but increased our profitability by 98%.
Wow, that's awesome.
And yeah, not again, this is not like, hey, this is a great thing that we did, but it would never have happened without some serious financial acumen, you know, as a marketer, help me make the offer, right? Like
Mm-hmm.
I can present the offer, I can try and make it compelling and make it known, persuade. But if we don't have sound logic between what that should be that best aligns with the business, it's only half the equation.
Yeah, no, that was brilliant. Taking, especially when, the easy answer, or probably would have failed, but if you had just taken all dogs and bundled them. But the fact that you were able to put some gems in there and price it accordingly and package it in a way that you were able to get rid of your unwanted SKUs and products. What I hope is that the the inventory levels of the quote unquote dogs that you're referring to weren't so high that it was a high hurdle to get rid of. You hope that the 80/20 rule, the 20% of the SKUs that were generating the top line number, um, was what was being produced, and ultimately, what you had in inventory on a larger scale. So, hopefully you didn't have a whole lot to contend with. And when you're managing SKUs and trying to pare that down, that can be a very challenging exercise.
Yeah, I think it worked out for that story, but I will tell you, it's definitely an ongoing. Like every company, one of the most fun parts about being a fractional is that every company is unique and a new challenge. So it's like, all right, that same play is totally different for company B versus company A. But how do we take the gems of knowledge of like what we did there, what are the principles that apply? So my question to you is, what are some of the principles that you apply across industry or company when it comes to setting a marketing budget?
Yeah, I mean, the principles lie in the need for marketing and advertising, and then how, and then what it costs. There are
Mm,
some industries and products that really do require, TV ads or billboards, something that's a little bit more expensive. There are other products that honestly can survive on, social media clicks and a few things that are not terribly expensive. So you look at a lot of different factors and layers in terms of what the product is, what your audience is, where they're getting their information about the product online or just line of sight. Um, you also look at whether it's a business or whether it's a individual or consumer. Um,
mm.
regionally there might be different ways and needs for a particular product, so there are a lot of dimensions there, as you know, as a CMO. I mean, that's why you make the big bucks. I apply the dollars to it and make sure that as we look at the ROI is there, and then how it scales in proportion to the existing sales performance. So if it's a $1 billion business, are we representing or investing marketing and advertising, what, 12% or whatever it is? And then, should we go to 20? What will that get? Will it make you a $1.5 billion company or 1.04? You know, and that's, you want to make sure that the incremental investment matches the incremental return.
Well, and that's the other thing too, is like projecting out, like you doing the analysis, say, all right, if this, then that, right? And getting some sort of range of, okay, well, if we put the budget here, we could, with this logic, if it stands, could expect this return. And I think when it comes to measuring ROI, you need to have a band, right? It should be a range. It shouldn't be a number. It shouldn't be if we're not doing 30 to 1 ROI, then we're failing. It's like, well, if it's within 15 to 40 ROI, then that's tolerable, and we should obviously try and do as best as possible. But then there's the element of volume and scale, right? Because typically the more you spend, the lower that number goes down until you hit economy of scale, then it can go back up and things like that. So I think the nuance what in your answer is what's really key for people listening to kind of gather. I focus on B2B for a couple of reasons. Don't need to go into why, but for any other thought experiments, I'm just going to assume we're talking B2B. Um, One of the other things that's really interesting too, Martin, is where a company's at in their growth cycle. And I've noticed that there's some companies, like let's just say there's two example companies, both B2B, both service. Let's say they do, gosh, pick an industry. I don't know. Let's say they do consulting. That's easy,
Okay.
right? One of them was the trailing the T12. They were at 9.8. Then this year they're at 10. So they grew marginally. And in the prior years, they were maybe between 9.5, 9.6, 9.7. Pretty consistent, like marginal increase. And let's say the example B, they were at 5 to 7 to 10, and they're in year 4 and they want to go to 15. One of the ways that I look at that is, okay, well, if you want to stay the same, I typically recommend anywhere between 8 to 15% of top line revenue as budget without, if I didn't have a Martin on staff to do the analysis, right? Simple ballparks. But company B should be closer to 15 if you want to keep going to the moon. And company A should probably be closer to 8 because, in my mind, you're going to get relative like less growth for every dollar if your historicals have shown that you're not on an upward trajectory. With that thought experiment in mind, how would you look at it? Because I want to hear from the
I
from the
mean,
money math expert.
I wouldn't necessarily disagree with that logic, although that logic doesn't always hold true.
Mm-hmm.
because company A, the one that is more mature and stable, in your example, could very well be more highly competitive. So you probably, think Coke versus Pepsi, right? I mean, they
Mm,
have to unload a ton of money into advertising because it's highly competitive in the drink market. So it just depends on what space it's in. Company B very well may not need as much marketing dollars if the industry itself is growing at an exponential rate. So in other words, all boats rise when the tide rises, right? I'm only giving the counter example, but probably the less likely one.
mm.
Point, if you want growth, you probably need to invest in advertising and marketing more so, all other things being held constant.
And competition matters tremendously to your answer, is
Mhm.
what I'm hearing.
Yeah.
Yeah, that's interesting. So when going back to, how to look at ROI, when I find that with marketing, one of the points of education that I have to make with clients is that growth isn't always linear. What I mean by that is if we start a campaign on day one, on day 30, don't expect like a 20% increase. On day 60, a 40%. On day 90, a 60%. Like it probably won't be a straight line.
Mhm.
There's usually that ramping up period where then it starts to
Hockey
hockey
stick.
stick. And yep, exactly.
Yeah.
Now it's not always guaranteed a hockey stick. And there's some months that we go backwards because maybe we tried something and tested it and said that didn't work, and then we make a tweak and it goes, we increase. But when you're doing your planning and your analysis, how do you account for what I call time to value, or TTV, of making these investments in marketing?
And you're talking about like the runway for realization on
Yeah.
the return.
Yep.
I mean, it certainly, that's where I would lean on a professional like yourself to really have a good understanding of, okay, this campaign will involve these activities, online, um, campaign, trade shows, billboards, radio, whatever. And this is what we expect to get, and this is how the bumps are supposed to come through if everything works the way it's supposed to. And then we kind of dial in probably something on the conservative side in terms of a return. You just still have to expect results on it, whether it's slow coming or towards the tail end. It really depends on how the campaign is structured, the seasonality of the product or service, um, as well as the other factors that are needed to shape that curve, which, as you say, is, as much as we'd like it to be a hockey stick or a straight line, is more likely to have ups and downs along the road.
Yeah, like the US stock market. Not like we're talking investing,
Yeah,
but like
yeah,
at what point has there ever been 12 months in a row with predictable straight up, gains? I don't know if that's ever happened, and if so, I'm not a professional, but really when I look at all stocks, they do this and they have a
they do a trend line, right?
trend line. Yeah, cool. Well, I hit you with some rapid fire tactical type questions that were thought experiments. It's kind of fun.
Mhm.
I love the perspective, but the concept of spending with discipline. How do you approach that idea, and how do you educate and communicate that with founders? And then after that answer, I want to give you why I'm asking that question.
Sure. So I look at two different pieces of the puzzle. I look at the strategic plan and long-term vision. Um, when we design a marketing campaign or investment in it, we certainly look at financial stability and its ability to meet strategic objectives. Balancing short-term investment with long-term financial planning is certainly the art to the science, with respect to both your discipline in marketing and mine in finance. The other part of it is to make sure that as a steward and fiduciary of the organization, that I look at the risk management and the brand health, long term and short term as well, by measuring financial risks and ensuring the liquidity and profitability are maintained, um, consistent with the strategic and operational goals of the organization. So we make sure that for brand health, that the changes in customer behavior and kind of the stickiness and efficacy of those campaigns translate into meeting those financial forecasts and the top line growth. So I'm constantly monitoring those things. I'm constantly having conversations with the CMO or top marketing professional to ensure that those things are on track.
Yeah, I think one of the things you mentioned in some of your answers was making sure aligned incentives tie back to the overall strategy. And it's so important to keep that in mind on a day-to-day, week-to-week, quarter-by-quarter basis, because I've worked with some cavalier founders that have made some pretty impressive businesses. And when marketing's great, it's like, all right, double the budget. We hit our numbers this week. We've exceeded projection. Do more of that, and I'll get the edict to, you know, drastically increase budget. And it's like, oh no, we weren't profitable this week. Cut that in by 75%. And then I'll take the baseline and then put it in half. And then we won't hit the numbers, but we'll be more profitable. And that's an extreme example, right? But
But not uncommon,
but
unfortunately.
not uncommon.
Yeah.
So that's one of those times where I wish I could phone a friend like you, Martin, and be like, hey, back me up on how to how to not artificially change the trend line that we talked about before. And how do you manage the personal side, the personality side, right? When you're working with founders and owners that they may be, obviously it's their business. Our job is to give trusted advisory and say, hey, based on this logic and experience, we think X, Y, and Z is the best way to approach the plan. But how do you navigate that relationship where someone's personality kind of gets in the way of the strategy?
Sure, yeah. Personality and emotions are all part of it, as is the overall people component. And finance, while the numbers don't lie, it's as a finance organization, you're still managing people and you're still managing those feelings and emotions. And generally speaking, the CFO is looked at as the voice of reason and the objective and level-headed person that hopefully is the person that keeps the company grounded in its strategic plan and long-term objectives. And I take that role very seriously. I do like being an advisor, and I like making sure that the company is sound financially and short term and long term. And that involves balancing both. It involves making sure that the investment is properly made in marketing and the sales team and growing top line and looking at promotional activity and things like that, while at the same time.
All right, we're back.
Oh, cool. So yeah, and making sure that in addition to investing in those activities, that we're also looking at the risk management and kind of the conservative side of things and reining in things when it seems like we could just double down and double our profits. That's not necessarily how it works. There is an oversaturation in terms of marketing, as you're well aware of. That you don't necessarily want to double up your investment. It might be counterproductive. So I look at my role as the person that kind of says, okay, well let's think about this. Let's look at the information and the facts, and let's be diligent about it. And if it requires increasing spending, maybe it's increasing 10% instead of double. I mean,
Mm.
it still might be reasonable to expect an additional investment. The question is how much and what do we expect to get out of it?
Nuance to everything.
Of course.
And AI can't replace the human element with the relationships and the nuance.
Fortunately,
Not
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 yet.
yet. I say that as of March
Yeah.
of 25. Maybe that'll change. But
Mhm.
Lauren, what are some topics that you feel strongly about that you want to communicate, when it comes to speaking on finance and for small businesses that maybe I didn't ask you about? What are some things I should ask you about that that, are like your core focus swim lanes?
I mean, in addition to all of the great questions you've asked me and all the different pieces that we've talked about, we don't often look at the risk component.
Mm,
There are a lot, and I touched on it in your previous question, which led me to think about this one. When you talk about risk from a brand perspective, in terms of oversaturation or overexposure, or just changing your image or slogan or motto, those things have serious consequences. You also look at just obviously liquidity risk, profitability risk, and the risk when venturing into new markets and developing new products, and you have operational risk as we might be promoting a product that we want to reduce 20%, but turns out tariffs are going to increase the cost by 40%. You don't know, right? So we have to kind of look at that profitability on a day-to-day or a fluid basis, as things are always in flux, and making sure that we're not blindsided, or there are no gaps to kind of our way of thinking and our approach to our go-to-market strategy.
man, you really had me. I have to tell a quick story based on that because the risk mitigation part is so often overlooked. Everyone, I referenced this concept of value equation, which is, your top, which is your value adders, like how do you increase lifetime value? How do you get more customers, make them spend more, stay longer? All the things that are exciting for a founder that like they focus on, like growing the business. But then the bottom, the denominator of that equation is mitigating risk. So like reducing churn and like reducing the pain for customers and business owners, like really risk mitigation. And one story that honestly, I'll just tell you why I typically don't tend to work with packaged goods or import export like physical products as much, is because not that I don't have experience, not that I don't think they're great companies, but when I was a CMO of a business that was importing, this was during COVID, cost of container to get from Taiwan, China was $4,000. At the peak, it was $40,000. So the cost to get that good over here was 10x. And the time for it to be delivered went from 45, 60 days, which was tolerable, right? You could forecast, to sometimes 18 months. And that was an extreme example, right? But when I'm used to selling products, and the conversation I had with my CFO were like, oh man, cash collected is not where it needs to be at this point in time. And which would then lead to, on the surface level, sales are down. I said, well, check this out. Sales are way up. And they're like, what? And the delta was back order. We had a back order of about 7 times normal. And that's one of those things where if you don't have somebody thinking strategically from both ends, you got to deal with the here and now.
Yeah,
And
as a CFO, certainly, working with the sales and marketing folks along with the logistics and the operations folks is very critical. It's funny you have that type of story. I had a client that had a lot of product move through the Suez Canal right after COVID 2021, 2022, and had similar numbers to share, where went from $300 a container to, it was like 13,000 a container. It was insane to be able to ship product because of everything that was going on in that area. And understanding that and understanding your cost structure is going to help you understand your pricing structure, because you certainly don't want to give away your product. In many
mm,
cases, if you don't track that stuff, you're paying your customer to take the product, which is terrible.
and I do marketing. I don't claim to be a chief sales officer. And with your role in finance, and you have to do some sales, business development to grow your firm, the number one rule that served me best is, and it's overplayed, is under promise, over deliver in sales. Because if you over promise, under deliver, you can't, there's like, how do you dig out from that missed expectation and that tarnish to your brand? But I've really learned that, sure, that's great in theory, but as long as you just do what you say you're going to do, and you have that trust that, like, all right, I'm going to do X, and you can verify that you did X, like that's almost even more believable than under promising over deliver, because when you have that misalignment of expectations, even if it's for the positive, there's still a misalignment of expectations. So how do you look at the sales process for your own CFO firm? Like, what are some of the rules or heuristics that you use when you're looking at evaluating new clients and articulating the deal?
Yeah, I mean it's all of the things that anyone else would look at. You know, I look at my utilization rate, I look at my billable rate, and ultimately, I also have to look at the, as you call it, um, under promise over deliver aspect of it, in terms of making sure that I'm giving my client the appropriate amount of time, where I'm not spending twice as much time, and at the same time, I'm also not, spending half as much time either. So, that would not be fair either. So, as you say, it's really just making sure that you say what you mean what you say, and you deliver on those expectations, on myself as well as those that the client expects of me.
What are what are some of the questions that you typically ask a CMO when you're engaged with a client? Like how do you navigate that relationship? How do you manage that relationship with the other side of the table, so to speak?
Sure. I mean, as a CFO, I mean, I feel the need to learn to speak the language of the other individual. In this case, I learned marketing speak. With a salesperson, I learned sales speak. With an operating COO, I learn operations speak. Because if I can't explain to them what's important to them, from a financial perspective in their language and their terms, I may as well be speaking to a brick wall.
Mm.
uh, Conveying that message, and making sure that it's received, that it's understood, that again, we're aligned and we're building that relationship so that the relationship is mutually beneficial. The marketing CMO, has his or her objectives to achieve certain strategic goals, and I just have to make sure that it's done profitably. So I think of myself like a point guard in basketball. I want to make sure that I'm putting the ball where you're going to be, not where you are, so that you're in a position to score with the highest level of probability in the easiest way possible. If the marketing professional wins, I win. I mean, it's that simple.
Yeah, it goes back to aligned incentives, but furthermore, it goes to having the empathy or the understanding of putting yourself in their seat and being able to speak a common language. And hopefully for anyone listening, they get a sense that, you know, too often does marketing get this bad rep in an organization where they're at odds with the sales, like marketing and sales points the finger. And then also too often do I think that the front of house where they bring business in and the back of house where they manage and allocate the funds are at odds. Really, the best is to be on the same page and have that empathy that we're all speaking the same language as leaders.
Yeah, I mean, generally speaking, we love Mike Tyson, and his quote is a great one. If you know the quote, and that quote is, everybody has a plan until they get punched in the face, right? And following the plan from a marketing or sales or finance perspective, easy peasy if everything works and everything goes according to plan. But what happens when there's a supply shock? What happens when there's a downtick in consumer demand, or the interest rates go up, creating inflation and all that other type of macroeconomic challenge, um, tariffs, supply chain issues, you name it. What happens, and how does that ripple through the organization, and how do the leaders of that organization conduct themselves and work together to resolve a common problem? When prices go up, the sales and marketing strategy have to respond accordingly. The question is how best to do that. The answer may not be knee jerk raise the price. It might be bundling, as you mentioned in one of your earlier solutions. It could be offering other types of incentives, from a shipping perspective, or so forth. So it's just a matter of putting your heads together and coming up with a goal that works for everybody.
Couldn't have said it better myself, so I won't try. Uh, one last question, not nearly as deep. Martin, how can people get in touch with you, connect with you?
Sure, I'm very much appreciated. You can reach me on my website, quiverandarrowllc.com. You can also email me at martinc@quiverandarrowllc.com. Um, I can also leave my cell phone if that's appropriate. I don't know.
Go for it.
215-779-3158.
Awesome. Well, thanks so much for coming on, Martin. I appreciate the conversation.
Well,
For everyone listening, I don't run ads in the show. I don't plan to run ads in the show, but what I do ask is that if you enjoyed it and you think that someone out there would benefit from this conversation, just share it. It's the only way it grows. Until next time, everyone, be well. Thanks so much.
thank you for having me.